Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Marc Rowan, CEO of Apollo. Marc, nice to see you.
Thank you. Thank you for having me.
So why don't we start out by you telling us a little bit about the various lines of business that Apollo is in and what your priorities are, Marc.
Sure. So we're in two lines of business. One is the asset management business, which is what people assume we do. Apollo Asset Management ended the year roughly $550 billion, $400 billion of private credit, mostly investment grade, $75 billion of hybrid equity, $75 billion of private equity. Very interesting business, lots of interesting things to talk about. The other business is a business people don't know as well, and that's the retirement services business, which we do through Athene. So in 2008, we started with a $16 million equity investment. We ended the year at $330 billion and have become the largest provider of retirement products in the US, number one market share in annuities, number one market share in pension, and an awesome business.
I want to talk more about that retirement business, but first, private equity. I mean, you guys are known as a private equity shop, and how big a part of the business is that sort of core private equity business at this point?
So the core private equity business is about $75 billion today. It's an incredibly important business. It's one we do very well. We have an amazing team that does this, but it is not a growth business. Done well, it's actually a farming business. We plant, we harvest, we plant, we harvest. But literally, we run this business for rate of return. If we do a good job for investors, we will grow a little. If we don't do a good job for investors, we will shrink a little. But we don't run that business for growth. We run that business for rate of return.
I take it you see the retirement business as a growth business then. Why is that, and how did you guys decide to move more into that area?
So the market tells us what we need to do. And so in the retirement services business, you have aging of the population, you have need for retirement income, you have lack of reliance on public pensions, Social Security, and the like. All of the trends speak to growth in the business. And that's what's happened. We've gone, as I suggested, from zero, a startup, to $330 billion and the largest factor in the market. And the reality is, people need to save for retirement. We are in a massive deficit in this country in terms of providing for retirement income. And this is one of many solutions, and we do it really well.
But I thought there were all these incumbents already, the Fidelities, the Vanguards, the Schwabs. I mean, never mind all these millions of boutiques around the country that help you do that, right?
You know, it's an interesting marketplace. So we are in the market for providing guaranteed retirement income. And if you think about our business model, we make money by investing our assets at a greater rate of return than we pay out on our liabilities. And because we are both large and highly rated, we are 95% of fixed income, of which 95% is investment grade and 5% equity. As a result of being a good investor, we have been able to offer very competitive and very attractive rates of return. And in the US, this is a tax-deferred way for people to save for retirement, which makes it very attractive.
Why is it that you think, my understanding is that alternatives have a very significant place in retirement? They're illiquid. Isn't that really dangerous for retirees?
You know, it's been an interesting journey. So we thought of the word alternative, if I go back 35 years, as being something high octane, private equity, venture capital, a hedge fund. Now I look at the definition of the word alternative. Today, I think of an alternative as nothing other than an alternative to publicly traded stocks and bonds. We also used to think private was risky and public was safe. 2022 was a good opportunity for us to realize that public can be both safe and risky, and private can be both safe and risky. The only difference is a degree of liquidity. So how many retirees, people saving for their retirement in their 20s, need all of their money Tuesday? Very few. How many institutions need all of their money Tuesday? Very few. And so if you are the kind of entity that can tolerate illiquidity, and you can get paid for that, it seems very straightforward that investors should harvest illiquidity premiums to add to their rates of return. And then I look at what's happened to publicly traded markets. 20 years ago, there was alpha left in publicly traded fixed income markets. Firms like ours offered you a high yield bond account, a levered loan account. These are not things we do anymore. Fixed income markets, broadly syndicated and publicly traded, are now without alpha. They are all beta markets, which is why people get to buy them very cheaply. Open-ended mutual funds, ETFs, derivatives traders dominate these markets. So if you want alpha, you need to step away from that competition and go private.
So why, though, is this a good deal for investors, for retirees? I understand why you think it's an appealing business. What's in it for the moms and pops of the world?
So for investors, they need to decide what risk they're going to take. You can take credit risk, you can take duration risk, you can take valuation risk, or any one of a number of other risks. But if you think about someone who's saving for retirement and has a very long time frame, are you really taking liquidity risk? If you can get paid for liquidity risk and earn excess return per unit of risk for simply being less liquid, which you're going to be anyway, it just seems so sensible. And again, private or less liquid does not mean riskier. A lot of what we do is at the investment grade level. If you can earn single A corporate bond rates plus 300 for being less liquid for 90 or 180 days, it seems like a pretty good trade.
Some see structured credit solutions as increasing risks in their portfolios, though. Can you explain?
Sure. If we think back in history, banks were the primary source of credit. Banks today are less than 20% of all the credit in the US marketplace. So who are the new banks? All the investors are now the new banks. The investment marketplace now supplies 80% plus of capital to US consumers and US businesses. Then you look at the word private credit. Private credit has historically meant levered lending or less than investment grade, things that do have risk. Sometimes they're attractive, sometimes not. Right now they happen to be very attractive. But we've never thought of private credit as being investment grade, just because it hasn't been offered before. The bet we made back in 2008 was that the private investment grade market was going to be an amazing business. And I believe we're right. Much of the world needs safe yield. Retirement services companies need safe yield. Institutions need safe yield. Consumers need safe yield. And if they can get paid for illiquidity and can bear it, I think that's an amazing risk for investors to take.
What about the regulatory environment? I mean, aren't we really talking about a shadow banking system? And is there a lack of regulatory oversight here?
There's plenty of regulation. Let's start with that. Every bit of gray hair I have is as a result of adapting
Not
to...
that much, actually.
Well,
All right.
I've been cutting it off.
Okay.
But getting to the regulatory system that we have. But in 2008, 2009, following the financial crisis, officials made a choice. Did we want the supply of credit to U.S. markets to come from government-backed, guaranteed banking institutions, or did we want it to come from investors? The decision was clear. We wanted it to come from investors. Dodd-Frank actually was designed to restrain the growth or the percentage of the economy that was dependent on 4 large banks, and it worked. Investors are, in many cases, ideally situated to be able to supply credit and take risks. Institutions have long-term timeframes. Insurance companies, long-term timeframes. Investors, they're used to things going up and down and socializing losses. This is an amazing thing for the U.S. economy. We forget, we are 50% of the world's capital market. We are the envy of the world. This is a strategic asset for us as a country. So now you come to the notion of private credit and regulation. I think there will be more regulation, there's no doubt. The world we're living in today and its interconnectedness causes people to be curious about how credit is created, but that does not mean unregulated.
Mm-hmm. So it's a competitive business, increasingly so. Others are coming into this area. How do you feel that Athene is positioned versus all the competition?
So if I think about the alternatives firms, each of the alternatives firms was roughly the same size in 2008. We were circa $40 billion of AUM, 30 billion of private equity and 10 billion of something else. And everyone made a slightly different bet, if you will, as to which way their business was going to go. Some bet on commercial real estate debt and equity. Some bet on infrastructure. Some bet on subordinated debt and BDCs. Our bet was private investment grade. We really have not seen competition come from other alternative asset managers because no one has the need that we have for private investment grade. Athene gave us the need for private investment grade. Athene, growing so fast, needs credit every single day. But Athene wants 25% of everything and 100% of nothing. So over time, we began to bring investors in side by side with Athene.
Wait a second, what is 25% of something and 100% of nothing mean?
Well, you want diversification. If you're a regulated insurance company with an A+ rating on your way to AA, you don't want concentrations. You want access to credit, but you don't want any concentrations. So you want 25% of everything and 100% of nothing. So as Athene buys 25% of everything, clients of ours, institutions, other insurance companies, retirement systems, wealthy individuals come in side by side aligned with Athene. And that's just an ecosystem we have built that is now in total some 400 billion. When I see competition, I see PIMCO and BlackRock and regional banks much more than I see our alternatives peers.
Mark, some people have raised questions about Athene and the risk associated with the business, given that investors could cash in their annuities early. I think there was a report that suggested somewhere around 18 to 20% of Athene's portfolio or liabilities is potentially at risk. Your stock has been a little bit under pressure versus your competitors year to date. What do you say to investors to assure them that this is not a big risk?
First, we're in the education business. This is not a risk. It has not been a risk, and it's really never been a risk for our industry. Fundamentally, people use annuities and pension for retirement. They are in tax-deferred accounts. People don't trade them. They don't withdraw them. And by the way, if they do redeem them, they do it after surrender charge periods and after market value adjustments. And when they redeem, they go into another new annuity product. This is how we run our business, and it's actually, very poorly understood. We have 9-year assets and 9-year liabilities. We're hedged from an interest rate point of view and a protection point of view. But at the end of life for an annuity or end of life for a pension, we want people to surrender. We don't want to build up a book of business that is unprotected by surrender charges because it's very hard to invest against, as the current environment is showing us. So we went from being a non-factor in the industry when we started to the largest market share. So as these policies mature and as they come out of surrender charge period, they retire, which is perfectly fine, and then people buy new policies. We are the largest beneficiary of that. 4 years ago, we were 20 billion of new sales, then 30 billion, then 47 billion. This year, we'll do north of $60 billion of new sales, and it continues to be. From a planned point of view, surrenders are a course of life. From an unplanned point of view, crickets. No increase in phone calls, no increase in surrenders, no increase in activity. And by the way, we've seen this before. We saw it with AIG, we saw it with Genworth. The industry just operates in a fundamentally different dynamic than a bank, which borrows short and lends long.
So the market is misunderstanding your business to a degree, and you're trying to convince people that it's all clear here with regard to this business.
It's always about performance and education. What I would say is the following. The word insurance is enough for some people to cause their brain to fog up and not to focus over time. And when I look at what we've done, we have actually grown book value at about 17% for the last 12 years. We've outperformed our industry in terms of new sales. We've outperformed our industry in capital generation. We've had fewer credit losses. And what investors say to us is, well, we need to see you go through a credit cycle. And I keep saying, we've been trying. The Fed keeps saving us, unfortunately. Maybe we'll have an opportunity to go through an honest-to-goodness credit cycle, and that will give investors the understanding that the risk we're taking is not credit risk. The risk we're taking is liquidity risk. And by the way, this is the risk we want to take. We get paid for illiquidity, and we're able to absorb it.
Well, with the cycles, be careful what you wish for a little
Exactly.
bit. I'm sure you know that. Final question here. I want to ask you a little bit about commercial real estate and what you see over the horizon, say, for the balance of 2023 and 2024. Where are we with that cycle?
Look, we have a massive commercial real estate exposure in the investment marketplace, in the banking marketplace, in the fund marketplace. We as a country.
Right, as a country, not
we Apollo.
Not you, Apollo.
Everything that was purchased prior to 2022 is today worth less. The change in cap rates, the change in interest rates has simply made the market worth less. That does not mean everything will be poorly done or that investments will ultimately lose money. It just means at the moment, we're going through a cycle. But we are going to go through a fundamental cycle. And that means losses will be incurred. First, we have changes in use. Think of office, think of retail, think of other use cases, which are just not as attractive. Second, we have leverage. People borrowed thinking that they were going to be able to support this real estate at 2 and 3%. Well, guess what? It's now 2 or 3 times that. So I believe we will see a real shakeout in commercial real estate. It won't hit everyone the same way. People will incur losses, but I think it will be a second leg down for our regional banking system, unfortunately, because they are in many ways the most exposed to debt and mortgages, whereas I think the equity losses will be socialized throughout the investment marketplace across a wide swath of investors.
Marc Rowan, CEO of Apollo, thanks so much for joining us.
Total pleasure. Thank you very much.
Thank you. You've been watching at Barrons. I'm Andy Serwer. We'll see you next time.